Meantime, talk markets. Barry Knapp is here, Ironsides Macroeconomics Managing Partner, Director of Research, and double black diamond expert on everything. Good morning to you.
Good morning.
What do you think you're going to hear from Powell? Do you think he's going to show his hand? And what does that hand look like?
First of all, I was one of Steve's respondents, and
I don't know if I've ever met one.
Yeah, right. Exactly. Well, he
keeps
book
them
bar,
secret.
but
he keeps them secret.
So for me, the key issue that you were getting at with Steve, and for Steve even to ask about, is in September, the Fed had been on this, call it immaculate disinflation path for most of the year. The idea was inflation was coming down. That allowed them to stop the hiking process and even talk about reversing it later on. But in September, they put out a forecast that said that they weren't going to reduce the policy rate to below 5% for something like 15 months. And he added a variable in as much as he decided, or the committee decided, that they needed weaker growth and higher unemployment in order to actually start reversing some of the rate hikes. And so that's the key issue, because Waller intimated that that wasn't the case, that if inflation came down, even if the unemployment rate stayed below their estimate of the long-term equilibrium rate of 4%, they could still cut. But that's a real change in the way, the framework that Steve was talking about that he put in place in September. So at that point, I'd been expecting the market to rally, finish the rally retracement of 2022 and finish the year at 4,800. But when they added that framework in September, to me, that was a big negative change. And then I changed my forecast and said, oh, no, I think we're going to probably to 4,200 first. Of course, we went to 4,100.
Right. Then
the Fed partially pivoted again. I called it a policy put. When long-term rates moved up, they said, OK, well, as you intimate, or said, the market's starting to do the work for us. Well, here we are. All right, we're going to get the forecasts. Are they going to change the framework from slower growth, high employment, and lower inflation to just lower inflation,
right,
which is a pivot back the other way? And now that's, you ask about credibility. I mean, how do you even
But if you even entertain
this?
the idea that you're going to lower rates, isn't that going to work against him?
100% it will. 100% it will, yes, because what I was saying with respect to the bond market was that any rally was suspect if it wasn't led by two-year notes. Mm-hmm. And the idea of the only way two-year notes can really rally significantly is if the Fed's ready to cut. So, sure, but that...
Although they've done it on their own. They've assumed that the Fed was...
That's right. But ultimately... I was in the camp that they're going to cut at least 4 times next year. I thought they were going to start in March until we got Friday's unemployment rate decline to 3.7 from 3.9. Now I think it starts in May. But the reason I'm so convinced that they have to cut next year is because of the inversion of the yield curve. Now, this has created a real problem for small banks, a real problem for small business, and to finance the federal government, right, quite frankly, because what Treasury Secretary Yellen did by issuing a ton of bills, okay, that's getting funded out of government money funds, but the rest of the issuance is in the so-called belly of the Treasury curve, 2-year notes to 7-year notes. That's the banking system buys those securities. And the banking system, small banks right now are shedding government securities at a 20% annualized rate.
But how much do you think Jay Powell is actually thinking about the issues as it relates to not to the banks? I think he thinks a lot about. I don't know how much he thinks about the government debt.
Yeah, it's a fascinating question, because when you go back to the last similar period of this in the 1960s, Bill Martin, who was the Fed chair, famous quote I've used all the time, which is the Fed is independent within, not of the government. And they were very conscious of what it meant for financing the debt and deficits at that time, which were growing rapidly through the whole guns and butter and Great Society stuff. I don't know. I mean, I've got to believe that this is super important.